Thank you very much for having all of us here. Ashish is the founder and CEO of the Convergence Foundation and the founding chairperson of Ashoka University. We have Vetri, CIO of UTI Asset Management Company. Sanjay, CGM of Union Bank of India. We have Bala, who is the CEO of Aditya Birla Asset Management Company, is unfortunately stuck in lovely Delhi traffic, but will be joining us very shortly in the next 5 minutes. Gents, pleasure for having you guys here with us and look forward to a very exciting and educative session on the markets. I want to just make a few points before we start. We've seen this amazing trend of financialization, in the Indian markets. Incrementally, more and more savings are going into equities. We've seen a scenario where returns on equities have outperformed almost every single asset class in the last 5 years, and that is driving more money to the markets. India's market cap to GDP is almost at 1.5 times. India's rise in demat account holders has gone from 4 crore demat holders on March 2020, pre-COVID, to almost 17 crore demat holders today. As of August 31st, there are 2 lakh crores worth of filings in SEBI for companies to raise equity capital. Bajaj Housing, which went public and closed their IPO yesterday, saw 3.3 lakh crores of demand for a 4,600 crore issue. And the very interesting trend has been the rise of the domestic investor. And in my 27-year career, being a capital markets professional, never seen this tide. I mean, there is huge amount of flows coming from domestic money, and an interesting chat today will be with the panel on how can this capital be used to create long-term value in the country and not be really speculative capital. And the concerns are really around depth of the markets. What happens if the markets are overheated and you see a correction, and also how do we absorb all of this capital for capital formation. So with that, I will invite our panelists to make a few comments, and then we get into Q&A. Ashish, it's a pleasure to have you. Congratulations on receiving your AIMA award for corporate citizenship. You really inspire all of us, with your skills and the wealth, that you've put to use for greater good. And you've had a long-standing career in private equity and really founded one of India's finest, homegrown private equity funds, Chris Capital. So I'll start with you, your comments on how do you feel about India right now?
Maybe I'll start with the macro and global India and then come to financial markets. So I'm extremely bearish on global macro. Let me start with that. I think the Western world in particular, thanks to very high debt levels. I mean, if you look at debt to GDP, it's gone up dramatically in the last 20 years. And demographics has worsened. You've seen how even in China, demographics has worsened dramatically in the last 10 years. And in the Western world, they're below replacement rate pretty much everywhere. So for those reasons and the whole geopolitics as well, the world's a pretty risky place. Growth is going to be low in the developed world, much lower than it's been in the recent past. I think coming to India, we're extremely well positioned from a macro standpoint. In that, even during COVID, we were very responsible in not busting the fist, not taking our debt to GDP too high. So India, I think, is a safe zone in terms of macro. But when you come to financial markets, I think we're in the midst of an everything bubble. You know, there's a bubble everywhere. I mean, whether you look at the US, where you have this magnificent seven, which just keep going up and up and up. Corporate profits are at an all-time high. I mean, my own prediction is if you look at markets like the US, which is the bellwether market globally, it now represents more than half of global market cap. And my own feeling is that in the next 10 years, it will deliver close to a 0% IRR in real terms, 0% IRR in real terms. India will do well long term just because of I mentioned the growth, the macro stability, you know, all of those reasons. But I think we always forget that financial markets move in cycles. Whether it's bank lending, there's always a cycle. Same thing with markets, there's a cycle as well. And I think this cycle will end in tears. It'll end very badly because there's rampant speculation right now. I mean, the F&M volumes are a signal of rampant speculation. The whole SME IPOs is an example of rampant speculation. The fact that when you go to any ordinary place, all people talk about is the returns that they have made and the participation in equities. That's a sign of rampant speculation. So whenever this happens, I mean, my sense is it never ends well. And, you know, people will argue that, look, there's a lot of domestic savings and it's coming into the markets, 1 lakh crore of domestic savings coming in every year, or every month, sorry. But, you know, these things can turn. I think the thing is that all the retail investors, Vishal talked about, while India has done a great job with a great regulator, I think SEBI has been a great regulator, and we widened the base. But this widened base of people who have experienced equities have not seen a down cycle. I mean, even COVID was a blip. It wasn't a real down cycle. And so my worry is that the small investor will lose their shirt once again. Even high net worth people who are speculating will really get crushed. And it's not going to be a pretty picture as we go forward. So Vishal, on the one hand, I think we've done a good job in broadening our markets. On the other hand, I think we have to really be worried about the rampant financialization, speculation, and those things like what happened with the bank lending cycle. You know, everything went well, and then you had this downturn, NPAs, it slowed things down. On the equity side also, you know, if you have a down cycle, it will mean companies not being able to raise capital. It'll mean that, you know, people go into their shell for a period of time. So I would rather see a more steady increase in markets versus this rampant bull market where there's a lot of speculative behavior, which is likely to end very badly.
Well, those are great views, but you know, on the contrary side, we always hear that corporate balance sheets are in the pink of health. India is delevered massively. Every meeting we have in Ministry of Finance pushes us to make more investments. And people feel that the downside to valuations are low, just as a counter. While I agree with your views, but there are counter arguments. So, you know, Vetri, thank you for joining us at this panel. You're a veteran in investing. You know, you lead a formidable group of analysts and fund managers at UTI, and you've been with some fantastic institutions prior to UTI, and you know, set up many asset management firms. Do you share the same views as Ashish, and how are you thinking about investors who are investing in your funds and accessing the markets?
Sure. I won't go too much into the macro. I think, you know, Ashish has made some very relevant points about the state of global macro. You know, having worked in the asset management industry for over 2 decades, I can't but say that I'm delighted to see the kind of growth that we've had. I can't but say that I'm, you know, very happy when I see the kind of reach that we've managed to have in terms of getting through to investors. Mutual funds, when I started, you know, 24 years ago, were a push product. You really had to push it because people were saying, you know, why should I look at a mutual fund? Why not just stick with my, you know, fixed deposit? And today we actually see commentary about banks suffering because people are preferring mutual funds over, putting their deposits in the bank. So, I look at that and smile and say, mission accomplished. So, we've certainly done some good. But you have to worry about the fact that the market might be getting slightly ahead of itself. In an Indian context, I would say it's the valuations and the investor expectations which give me the greatest cause for concern. In an economy which is capable of growing 6 to 7% in real terms, 10 to 11% in nominal terms, if you've got an equity market which is priced at pretty much the priciest that we've seen in a very long time, and where the investor expectation is north of 15 to 20% returns per annum, these two things don't match. And when investor expectations receive a setback, it takes a very long time for, people to, you actually start to see outflows from markets, and it takes a very long time before you can get back to them. The one good thing that we've seen in the last decade has been the rise of systematic investment plans. I'm sure all of you track those numbers. Maybe many of you are invested through systematic investment plans. I think what's that done is it's allowed people to think longer term rather than just looking at it as a short-term investment avenue. But having said that, when we look through the data, without doubt, even those who are doing SIPs and investing in other schemes, there is momentum-seeking behavior. I mean, the SEBI data shows this. Hardly anybody stays invested for more than 2 years. And, we saw another extreme version of this when SEBI released some data on IPOs. People are flipping out and getting out within 30 days and 90 days. So, if I were to look at what are the positives, what are the negatives, I would just sum it up this way to say, I think the democratization of access to capital has been something which will continue to benefit this country for many years to come. 10 years ago, the research team at my current firm or any other firm I worked at typically had a universe of 150 to 200 companies where they carried out research. So they didn't invest beyond 200 companies. Today, most firms like ours have universes which have reached 500 companies. That's a function of the kind of assets that we manage, but also a function of the fact that there's such a wide range of companies we can invest in. So I think this is the wonderful thing that is happening in terms of creating a domestically driven capital formation cycle. But as Ashish wisely pointed out, equity markets are inherently cyclical. And therefore, I think it is wise for investors to sort of be prudent. And the message that actually we try to keep reiterating to investors is that eventually investing is about reaching your financial goals. Reaching your financial goals requires you to be disciplined in terms of asset allocation. Stick to that. The worst thing you can do in investing is choose to take on more risk because your neighbor is still making more money than you. And unfortunately, that's a much stronger driver of behavior than doing what is right for them, which is asset allocation and thinking long term. So there's both good and bad in what is happening, but I think, it's just part of the journey of democratizing the markets and making sure more Indians are able to participate and more Indian entrepreneurs can raise capital in the local markets.
Thank you, Vetri. It's a very interesting point you make on that in your data, you're seeing momentum in SIP investing. I mean, that's very interesting. Bala, thank you for joining us today. You're a stalwart of the mutual fund industry. You lead one of the largest asset management companies managing almost 4 lakh crores. And I know you are very involved with SEBI in a lot of changes coming for the mutual fund business. And as well as going to be credited very soon with the 250 rupee SIP, which is a game changer. And you've also led AMFI. Would love to get your remarks on this topic.
Yeah. So I think I was just looking at the number, how it evolved. Sometimes we ourselves don't believe what we have achieved in the mutual fund industry. The reason I'm saying is, I just looked at the last 10-year number. Whichever number I look at it, everything has gone up by 2.5 times, 3 times. Now, I'm not talking about the market. I'm talking only the assets and the management. In the year 2016, 2014, it was roughly about 10 lakh crore, 14 lakh crore size. Today is about 58 lakh crore size. That's maybe even the number even keeps rising actually. It's become now 60 lakh crore size. And if you look at the number of folios, we used to have about 4 lakh folios that we used to have. The unique investor, we used to have roughly about 1.7 or 1.8 crores. And today we have folios of close to about 20 lakh folios. And that's gone up. And then we used to worry about why all the money is coming only from Mumbai and Delhi, and why industry is not penetrating, going deeper parts of the country. So that time SEBI introduced B30, because first time ever we all of us together coined a word called B30, which is nothing but top 30 cities, and the next 30, the rest of the cities used to be called as B30 cities. Very simple. Nowhere in the marketing textbook also you will find these kind of words. But the moment it was done, there was a lot of seriousness that went behind in expanding the reach of the mutual funds, and now we are seeing the benefit of that. The B30 AUM, T30, it used to be somewhere around 85% of the mutual fund assets and management. It used to come from only Mumbai, Delhi, and so on and so forth. And today, the B30 AUM in the equity is now close to about 27 or 28%. So that's something, a big change that has happened. The last, which of course I would like to highlight, is in general, the investors in general are fixed income oriented in India. I think most of us are very conservative, believe in 7-8%, I'm happy, and so on and so forth. I think since the time the demon happened, I think since the time interest rates were brought to more stable kind of regime, where borrowers were getting money at a reasonably affordable rates. I'm talking about high interest rate regime, low interest rate regime. You go to bank deposits, you get about 6-7%. The moment that happened, we saw the fixed income dominance of the mutual fund industry start reducing, equity dominance have improved. I think that's why today, while we are sitting on out of 60 lakh crore, almost about 30 lakh, 35 lakh crores as the equity assets and management, rest is coming from fixed income. There's again a big shift that happened. So this is something, in my own belief, is have done good for the country. It's a good problem to have. I think we may have argument on valuations and where the market will head, whether 80,000 is right. And I always believe that even at 60,000, we never felt that 60,000 right. At 70 also, we never felt 70,000 is right. Therefore, 80, whether we can say whether it's right or wrong, it's something that always be a debatable point. The fact of the matter is, money which otherwise not coming to the capital market for so many number of years, and as Vetri mentioned, from a push it became a pull, because the experience has been good. People are seeking for investment which can give better return than a traditional investment, I call it. I'm not saying fixed deposit or gold. Traditional investment that all of them used to do. So that's something that has happened. Second, my own belief is, I think Vishal mentioned about a bigger shift has happened in the capital market. Most of the companies are heavily dependent on rising resources through the debt capital market and build their business. I think that's the way most of the Indian corporates are used to borrowing from banks and less on equity capital infusion and more of borrowed capital through which everyone used to build business. I think most of the Indian corporates are used to build business like that. And after the IBC got introduced and banks NPAs were rising, then after IBC, people start realizing I'm building the business, but tomorrow I will not know whether my business actually will stay with me or will go to somebody else. The moment the IBC came and NPA resolution became very, very sharper, most of the companies have started building the business not through the debt capital rising, through the equity infusions. As a result of that, most of the Nifty 50 companies, the borrowing leverage in which I think we are generally known for, that became lower, and today the leverage levels are less, and most of the companies are able to tap the equity capital market, and basis which they are able to build the business. This has now made it more stronger from the capital market point of view. Whether it can be captured in the valuations is something which John doesn't know, but improvement in the balance sheet, efficiency improvement, also the reflection of confidence, efficiency reflects in the valuation and so on and so forth. The other just wanted to, before I hand over to Vishal, I just want to highlight another number. Till about 2007, 2008, that Nifty 50 companies used to be about, used to represent 80%, 85% of the overall market cap. 85% of the overall market cap used to be represented by only Nifty 50, handful of 50 companies. Today the same number is about 50% only is coming from 50 or 55% is come from Nifty 50 companies overall market cap, and rest of them has come from the other companies, which essentially means other than Nifty 50 companies today are in a position to contribute to the larger market cap, which is also a reflection of the widening of base in the industry and widening of more and more corporates tapping the capital market, getting in the listed, and also increase in wealth effect is also now being reflected. That is something now being recognized in the Indian financial market. That is where the mutual funds have played a bigger role. And in fact, mutual funds are now become an accepted way of investing in the capital market. There is a complete behavioral change. I used to see the behavioral used to be, whenever I used to market, used to be volatile. The one common question used to be there, should I redeem? And today the question completely got reversed. Now the question comes is, should I invest? So that is the way it has happened. I think that's something, there is a significant progress that we have made as a country, as a mutual fund players, as a financial market player, in deepening the financial instruments of mutual funds across various parts of the country, which in my view will go a long way. And last but not the least, the banking industry deposit size or the mutual fund industry size used to be only about 13% of the banking industry size used to be the mutual fund industry size. Today gradually is now gone to about 23%, whereas worldwide, in US it's almost about 100% deposit size, more than 100% of the deposit size is represented in mutual fund industry size and globally, whereas India we still have a long way to go. So this is something, is a fact, money will come, market go up and go down and all depends upon how the economy continues to drive, earnings continue to come. And of course, so far the markets have been going up because most of the analysts have been predicting the expectation company's performance lower than what they have been actually delivering. So they have been outperforming. Maybe the time will come where the company will start underperforming the analyst expectations, and that is the time we'll probably see some kind of consolidation happening in the market. But the fact of the matter is, optimism is also one of the driving factor for both capital market buoyancy as well as for the mutual fund flows.
Thank you for those comments. Very interesting. I think, Ashish, coming to you, one big driver of investment in India has been private equity, global private equity. And, today you talk to any of the global private equity bosses. I mean, India is clearly one of the most important markets, where they want to commit capital. And even when we see the primary markets, almost 70% of all new issuance activity is happening by private equity-backed companies. From your experience, what more can we do as a country, as an economy, to encourage private equity investing from domestic capital? It's more, long-term in nature, more geared towards capital formation. And how do we, as a country, over the next 10 years, make that structural shift where, more of our capital goes into private equity asset classes?
Yeah, I think beyond private equity also, maybe looking at other instruments that are longer dated. Firstly, I think the retirement savings pool has increased. If you look at it as a percent of household savings, I think it was something like 11-12% of household financial savings. And it's gone up to almost 18% of household financial savings. So I think retirement is very important. The pensions, etc. The insurance portion has stayed stable. I think at around 18-20% of household financial savings. So these are two pools of capital which can invest in long-dated instruments. I mean, if you look at where does US private equity get its money from, it really gets its money from endowments, from pensions, from insurance, etc. And pensions being a big contributor. I mean, the reason the Aussies also got so much money is because of the superannuation funds. So I think if we can grow the pension market further, and there I think in terms of what the Aussies did in terms of mandatory retirement savings, contributed by both the employer and employee and sort of raising that a little bit, but offering choice is one way to grow the retirement pool. And already we've gone from 11-12% to 18%, so hopefully that will go up further. So in my mind, that would be the way. And then of course, as private equity or these other instruments start to generate reasonable returns and actually show that they can create alpha long term, then they can grow as a percent of the retirement assets or insurance assets, etc. So, and there I think that many of the players are responsible players. So hopefully it will happen as we go forward. Disclosure needs to improve further in that asset class. Unlike public equities, which is very, disclosure is very high, mark-to-market is immediate. I think we know there's some global issues around asset classes like private equity, where you don't mark-to-market. My own belief is that private equity globally maybe has grown to become too large. And many folks who are over-invested will actually be trapped, going forward. So I think in India we should do it prudently and not overdo it also.
Thank you. I think, Vetri, just taking on from a comment which, Bala made about the banking sector and the lending that happened in the last decade, which, resulted into a large NPA. But if you see the return on capital today from broad-based Indian companies is pretty high. And one aspect of that is that almost 10 lakh crores worth of bad assets changed hands through the IBC process, the SARFAESI processes in the last 10 years. And they changed hands to good companies who were able to buy these assets at significantly lower sort of value to asset prices, and they were able to generate significant returns out of them. And therefore, when you see return on capital compared to, say, a Chinese business in India, the returns on capital are a lot higher. And how do you think about that aspect when you're looking at long-term valuations in India? I often hear from investors that, if a company is generating 25 to 30% return, right? I mean, and it's growing at 10 to 15%, I'm fine paying a 35 or 40 times earnings on it. So specific question on valuations, how are you seeing it from a longer term perspective? Yes, there seems to be a bubble now, but what is your medium to longer term view?
Sure. So multiple ways to cut and slice this. One is, I would say, when you've got the economy growing in real terms at 10 to 11%, because that's the architecture that we have of growth and inflation. For the aggregate corporate sector to churn out ROEs in excess of 25%, I would say is actually just not possible, never happened. Today, if you look at numbers like the Nifty 50, the ROE is sort of at decadal highs at about, in fact, more than decade highs at closer to 15%. But I think this is also perhaps a cyclical peak, because as you see capital formation accelerate, you will actually see companies putting that capital to work, which will actually start to depress return on capital in the short term. So I would actually say, the equation at a stock level, you will always find some exceptional businesses with 25, 30% ROC and, fabulous growth metrics. They can have different outcomes. But the market aggregate as a whole, this is a very, very difficult equation to expect as an outcome. So I would actually submit that current valuations where they are, if you look at the Nifty 50, 21.5 times forward earnings, you look at its history, you look at the ROE, you look at the kind of growth, these are expensive valuations and prudence is called for. Further, Vishal, if you actually, as much as I like the fact that the markets have democratized, we are going all the way down the capital chain, investing even in, company number 500 or 600. The strange thing is that the valuations of this set of companies has actually exceeded what used to be for the top tier companies. And I find that rather unusual, because we know all the challenges that smaller companies have, whether it is depth and breadth of management, ability to deal with changes in regulations, economic cycles, access to capital. And when you see them collectively being valued at a premium to the large caps, it seems to me somebody's risk perception is not quite right. And that does give me, cause for concern when I look at it from a valuation perspective. So I think there are certainly some things to worry about when you look at this market from a valuation perspective. And, we've got to keep this sort of schism in our head. What is good for the economy, what could create incomes, is not necessarily immediately good for you in terms of being an investor in the stock market. Why? Because the stock market goes through cycles of greed and fear. You can't outlaw this. And because you can't outlaw this, you've got to think about what I believe are the three most important words in investing, which is margin of safety, right? And that is now vastly eroded. So I do think from a valuation point of view, there are issues to worry about. One final point, Vishal, and we see this in a lot of the data. You go back and look at the kind of valuations we had 2007, 2010, where we were in the late 1999, early 2000, the Harshad Mehta era, 91, 92. You will find that when those starting valuations were high, they were a permanent drag on forward returns, even going forward 10 years and 20 years, right? So I do think, therefore, you need to be careful that amber light is on. You could argue is the red light soon to come on. But as equity investors, this is a time to be cautious, not to be ebullient. So that would be my sort of simple message.
Vishalji, Ashish, Balasubramaniam, Vetri, ladies and gentlemen, it is my privilege to conclude this fascinating session on market. The session has been an education. The distinguished panelists have helped us appreciate the market trends and emerging investment dynamics. They have highlighted the role of market in India's ongoing economic revolution and raised important issues that affect investment and regulation. The discussion generated useful ideas for making India's market deeper, wider, and safer. Traditionally, the financial market have been the dominance of elite, which has affected both its capacity and stability. The market must be attractive for India's masses so that India's savings are readily converted into investment and Indian companies have a larger pool of capital to fund their growth and efficiency. Indian capitalism needs to be inclusive, and it is only when the masses can generate income from surpluses, however small, and the divide between Dalal Street and Main Street gets bridged. Mr. Kampani, thank you for moderating the session and raising several important issues and concern the market and economy. You extracted most out of short discussions and brought out the multiple perspective of market economy nexus. It was a pleasure being with you. Mr. Dhawan also touched on macro global scenarios. Bubble in financials, rampant growth in market should be an area of caution. That was his advices. Mr. Vetri, he touched upon mutual funds were a push product initially. Bank deposits, he touched on bank deposits degrowths also, and the rise in SIP. Democratization of assets were also touched by Mr. Vetri. Mr. Balasubramaniam, he touched the post-demonetization ROI decrease and stabilization and shift towards the equity that happened. We learned a lot listening to you. Your wisdom about the market clarifies many issues for the audience, and foresight helped everyone to get sense of what the future holds. You were fantastic, and many thanks for sharing your insight and ideas with us. Ladies and gentlemen, your interest and excitement during the discussion was quite obvious. Clearly, money gets people to concentrate. Many thanks for joining us in the session. As a banker, it seems that after this session, it seems that the job of a banker is going to get tough going forward. And that is going to help India in getting more innovative banking liability products in the market. Thank you. Thank you so much for the session. Thank you, sir.
Thank you all.
Thank you. Thank you.